happened with the Fed, mortgage rates, and housing. So let's take a look at the data and see what it means for you. Yesterday, the Fed cut rates by 0.25%, second cut since last month. We saw this coming. Last month, I locked all my clients' rates the day before the Fed meeting because the data already showed the need for a cut. Inflation cooling, job growth is slowing, and consumer spending was flattening. The same thing happened again this week. Markets saw the slowdown, expected a cut. We got the cut, and the Fed followed it up with a very cautious tone. Basically, they were saying, we're not promising any more cuts just yet. So this caution spooks investors. They pulled money out of bonds, bond prices fell, and when that happens, the long-term yields, including mortgage rates, they move up, not down. So even though the Fed lowered their rate, mortgage rates ticked up a little bit. That's normal when the market gets mixed signals like this. The key takeaway is the Fed is still restrictive, but they're watching the same data that continues to point to lower mortgage rates ahead. Where we're headed next, right now the market expects 120 basis points, roughly 1.2%, in total Fed cuts over the next year. If that plays out, we should see mortgage rates continue to trend lower through 2026, not right away, but gradually, and of course a bumpy road along the way. And even though the Fed tried to sound cautious, there's still strong confidence of a December cut here. Inflation and job data continue easing the way that they have been. There's short-term volatility, but the overall trend is still moving in the right direction. On the housing side, things are healthy, not booming, and not crashing. We have the days on market averaging about 3 to 4 months nationally. That's a balanced market. Inventory is still tight, but a bit up from the last year. We're finally seeing more listings, which gives buyers a little bit more breathing room. Pricing, home values are still rising 4 to 5%. That's what the data says, even though the median listing prices are coming down and you're seeing lots of price cuts. So here's the important distinction. When median prices are down, that doesn't mean home values are falling. It just means more buyers are purchasing at slightly lower price points. Sellers are getting realistic with pricing and buyers are finding value again. We're also seeing more seller credits and price adjustments. It opens doors for buyers to negotiate deals. So for sellers, current homeowners, those in the sidelines, the equity is still growing, just at a healthier and more sustainable pace. What this means for you, if you bought a home in the last 12 to 24 months, odds are you've gained some equity even though your rate was higher. Just 2 years ago, we were at almost 8% in rates, and now we're hovering above the low sixes. I'm already helping clients in that group to refinance at little or no cost and lower their payment or remove mortgage insurance. So if you're a homeowner, you need flexibility, this might be a good time. See where you're at with current market rates and also any other needs that might be in play. Do we need to consolidate other debt? Do we need to pull cash for home improvements, for landscaping or an addition, even considering a HELOC to access the equity without refinancing the entire loan. If you're thinking of buying, this is a great window. Inventory is up just enough to create opportunities. Sellers are more flexible. Use today's market to negotiate, then refinance later as rates come down. Step simple, get pre-approved or update your approval if it's been a while. And approvals from other lenders are not necessary